Hey guys, welcome back to another video. Today I'm going to be diving into LEAPS. LEAPS are long-term equity anticipation securities. And yes, the P in anticipation for some reason goes in the acronym. I don't really know why. Probably because it just sounds better. It's basically a call option, but its expiration is way out into the future, such as like a year. So as you can see on screen, I have Apple's option grid pulled up. So we're going to buy a call. We're going to go way out here, let's say January 20th, because that's very, very far. That's literally like 2 years in the future. For LEAPS, typically you buy them in the money. So again, just a quick recap. Anything above the current share price is out of the money. The share price is at the money, and then anything below is in the money. So these are all options that are in the money. So we're going to go deep into the money, which typically you would do in a LEAP. So currently the share price is 136. Let's pick this $65 strike price. What's so great about LEAPS? LEAPS are basically, you can control underlying security, but for a fraction of the cost of outright owning 100 shares, which basically opens up your portfolio a lot because then you free up cash that you can invest in other places. On the flip side, you leverage your position quite a bit. So as you can see here, it is $74.55 per share, equivalent to $7,455 to buy this LEAP. As you can see the theta, you're losing about 68 cents per day, which is a decent amount, especially when you're talking about that long of a time. But the key about this is the delta. The delta is very close to 1. Now, if you're owning 100 shares, you're going to have a delta of 1 delta per share, equating to 100 deltas. What is delta? Delta is basically how much the option will move in response to how $1 in movement of the security's price. So if the share price goes up $1, your option, or this option, is basically going up $1 or 94 cents per share. Again, but when you're controlling 100 shares, you're going up $100, very similar to owning 100 shares outright, which makes a lot of sense. Now, you guys are probably like, okay, wait a second, this is an option, you're leveraged, what's the downside, what's the risk, what's the upside, blah, blah, blah. So you guys got to wait it, of course. And I promise you, I'm gonna get all into that. First off, I got to talk about intrinsic and extrinsic value. $65 obviously has intrinsic value baked into it because it is in the money. So $136 at the current market price, that means this option has an intrinsic value right off the bat of about $70, okay? So, but you're also paying $74.55 for the premium. So why are you paying those extra couple of dollars? The reason is because of the extrinsic value. Now, the extrinsic value is a combination of implied volatility and time decay, which the reason why you're paying it is because you have a potential for your option to be swung deep for that because you have a higher chance of making more money. As you go closer and closer with the expiration dates, the extrinsic value will become less and less because there is a smaller chance for your option to be thrown into the money. Okay, why am I telling you all about this intrinsic and extrinsic value? Why am I paying this extrinsic value? Well, the reason is because basically you're paying for the time and you are freeing up a lot shares outright of Apple at the current market price, that'd be about $13,000. So you could either pay upfront $13,668, or you could pay the $7,455 and basically control the same amount of shares. Free up all this extra money. That's amazing because that means that you can put that money into something else, another investment. Okay, so obviously there has to be downsides to this, or else everybody would be doing it, and, well, everyone should probably be doing it because the downsides are very minimal in comparison to the potential rewards. So what are the downsides? Well, the day of expiration, if your share price on the option is below the strike price that you paid, well, your option is worthless. You are going to lose all of your money, the $7,455 that you put up for the option originally. The intrinsic value will be zero because the market price, as I just said, would be below the strike price, therefore expiring out of the money. And of course, your extrinsic value would be zero because it's the day of expiration. There is no more time for your option to be thrown into the money, thus making your option worthless. It expires worthless, you lose everything. Which sounds really bad, but when you compare it to owning 100 shares outright, if you were owning 100 shares outright, you can potentially continue to lose money. So if the share price, let's say, instead of just stopping at 65, it can go all the way down to theoretically zero, but if it continues to go down from 65 to 55 to 45, you can continuously lose money. Where an option, it's basically like a stop loss, and you just stop it there. But again, if you sell this option before the day of expiration, there will still be some extrinsic value depending upon when you sell it, and of course the intrinsic value will be different depending upon the current market price. So if you sell it before expiration, you can still sell it with extrinsic value in it. Now, if you do just hold it to expiration, you could just exercise this option, which it depends on the situation, of course, where the current market price is of the security. You're paying this extrinsic value to free up all this extra cash. Now, you're paying $2.87 extra of extrinsic value in this specific option. Now, I just took the market price and subtracted the strike price, which that's the intrinsic value, and then the leftover $71.80. You take that, and then you take the premium, and you subtract the number that I just said, the $71.68, which is the intrinsic value, from the premium, and then the difference is the extrinsic value, which is $2.87. So you're basically paying $287 extra to free up all this other cash. Now, what does that mean? That means you're paying $287 to free up about $6,200 that would have been invested in Apple. Now, what's the beauty of that? You, with that cash, can invest it, and then what percentage return do you have to make to break even on paying the extrinsic value? Now, I calculated this because I took the extrinsic value, the $287, and divided it by the extra cash that I would have on hand from not investing in the 100 shares and rather investing in the LEAPS, and you drag this decimal, you're looking at a 4.6 return that you would have to get on this 6213. But the craziest thing is you have about 2 years, so you have to make 4.6% over 2 years just to break even. Just to break even, and then anything over that, you're profiting on that cash, as well as if that LEAPS option is profiting, then you're profiting on basically both of those positions, making it more advantageous to buy this LEAP rather than buying 100 shares, because now you have two different investments that are making money. And again, that's just to hedge the extrinsic value. So there really is no difference between owning 100 shares and owning a LEAP except for the extrinsic value that you paid. But your reward is limitless, because if Apple decides to go up 100% over the next year, you're making that percentage. And the best part about it is that you put up half of the initial investment, and you're gaining the equivalent to $1 every single time. So your return is essentially doubled, okay? And the risk is not that much more. So just as a quick recap, basically owning a LEAPS option is very similar to owning 100 shares of the underlying security, except you are putting up a very reduced initial investment. In this case, you would put up, for this LEAP, you're putting up $7,455, which is freeing up $6,213. Now, you're paying an extra $2.87 per share, equivalent to $287, to free up all that extra cash. And by the day of expiration, yes, technically you would have no extrinsic value, but you would have the intrinsic value from the appreciation of the underlying security. Yes, you lost that $287, although from freeing up your $6,213, you would just have to squeak out a 4.6% return to just hedge that premium that you paid. Anything above is, again, just share profit more than owning 100 shares. It's just, it's beautiful. And you have, I guess, a downside protection, because if the security does go below your strike price, you're out. You're not continuously losing money, which can be a good thing, can be a bad thing, because yes, technically you're not owning those shares, and since it's just gone cash, you don't have any equity in collateral basically for that. The risk to reward here is just amazing. Now, you guys might comment like, oh, what about the liquidity? What about getting out of this option? And yes, technically, as the option gets deeper in the money, you will have less and less open interest and volume, which actually this one has decent open interest. Well, I think that's just because Apple, but yes, you will have less and less liquidity, although that doesn't really matter because your option is becoming more and more profitable. So then when the option does expire, it's going to be a very profitable trade. Yes, again, you will lose that extrinsic value, but you are recouping that from the freed cash from the LEAP. With this option, you also have so much intrinsic value automatically baked into the option that you're not really risking that much money when you are buying this premium. It is that very small sliver of extrinsic value. Now, again, the break even on this option, which I failed to mention, is just the strike price plus the premium paid, which on this one it's $139.55. You just get that because you take the current market and add the extrinsic value, which is not automatically baked into it, so it's just market plus the extrinsic value. So note that. Now I want to show you this because this is basically what Wall Street Bets does and how they buy options. They basically buy a very close expiration date. Right now I'm recording this on the 6th, so this is an expiration date less than a week out. The current share price of Apple is $136. So an out-of-the-money option that they are just hoping that hits within the next week, but the share price has to basically skyrocket very soon. So this is an out-of-the-money option, 142. Basically, Apple has to rise tremendously over the next week. And as you can see every single day, if Apple doesn't rise basically 5% within the next week, you're losing money. And not only that, like you're losing like all your money because it's out of the money option. Where as something such as this LEAP option, and go back over here, I forget what expiration I chose, January 20th, 2023, and we selected, I believe, the 65. Click here, calculate. As you can see, the break even is ridiculously low, and we don't really care if the share price goes up tomorrow, the next day, a week from now, a month from now, 6 months from now. It doesn't really bother us too much because we're in it for the long run. And as you can see, we're not as stressed out about our option because it has time. And that's the key, because we are leveraging our position in a very intelligent way by freeing up a lot of extra cash, and it can slowly rise, and we don't need it to make any drastic movements within any short time frame. And now this is great for a security that you're already bullish on and you're already wanting to invest a long-term position. This is just perfect. If you like these kind of videos where I'm explaining different option strategies, please drop a like because it really helps out my small channel. And don't forget to subscribe because I'm going to consistently upload these options tutorials. And I really enjoy doing them, although they don't get as much popularity as these crazy Wall Street Bets shorts that I'm posting. I think that this stuff's valuable, so if you found any value in this, I would really appreciate any support you can, and good luck in the markets. See ya.